We now turn to valuation of futures and swaps. Typically, people refer to this as forwards, futures, and swaps, but we're going to treat forwards and futures as essentially identical. And so we're going to be addressing how you value futures contracts in this module, specifically stock index futures contracts. It turns out we're going to explore the basics of carry arbitrage with futures contracts. The best way to visually understand this concept is suppose we bought some underlying instrument, tossed it in a burlap sack like a bag of corn, and carried it through time. We'll address all the costs of carrying it and then look at the futures price, which gives me the obligation to acquire that product at some future point in time. Carry arbitrage is a static arbitrage approach, which makes it fall under the market comparables approach to valuation. In this module, we'll focus solely on the S&P 500 index futures prices to see if we can find evidence of carry arbitrage. We're going to contrast fully arbitraged markets with unarbitraged markets, and then we'll begin to look at different derivations of values that can be found. The term premiums or marginal term premiums will be addressed in this module. The central finance concepts is basically illustrate index futures prices. What do they look like? Introduce forwards and futures. We're going to introduce the carry arbitrage model, and then look at fully arbitraged markets and unarbitraged markets. We'll explore other explanations of these futures prices, the net hedging demand theory, and the futures expectations theory. We'll couple this analysis with significant amount of empirical observations. In this module, we'll focus solely on the S&P 500 index futures contracts. In module 6.2, we'll look at a variety of other futures contracts. So suppose we observe the following price pattern. We have the spot index value, say the S&P 500 indexes, the value is 3,380. The first nearby futures contract, that is the one that will mature next, is 3,375. The second nearby is 3,361, and the third nearby is 3,331. So the S&P 500 index futures contracts trade on a quarterly cycle. And so the nearby could be anywhere between maturing tomorrow or maturing in 3 months. The second nearby is about 3 months from the first nearby. And the third nearby is about 3 months from the second. So what information is conveyed in this price pattern? Well, the unsuspecting analyst might say, well, the market is expecting the futures price to go down. And that is simply false. And what we're going to see is the only information conveyed here is that the dividend yield is above the base interest rate. And it takes quite a bit of convincing the uninformed person that there's no expectation information in this pattern for a host of reasons. But the professional quantitative analyst will understand that this is driven solely by arbitrage, and it's driven solely by the relationship between the cash flow received from carrying the underlying instrument and the financing charge that's required to 100% finance it. A forward contract, just by way of review, is there are typically two counterparties. There's the buyer and a seller, which is also referred to as the long or the short. A forward contract is an agreement between two counterparties in which the buyer agrees that at the expiration date, the specific underlying instrument will be purchased from the seller at a price they agreed on at the trade date. So it's an agreement today to do something in the future. Oftentimes, houses are purchased on a forward contract. You put down earnest money and you obligate yourself to buy the house. If you breach that contract, you lose your earnest money. If you agree to buy a car, Sometimes it might be a few days or a week or so before you actually take possession of the car. And so forward contracts are actually widely used. They're typically over the counter. They're not that highly regulated, and thus the agreed upon price is set in the forward contract. Forward contracts are not easily transferable. That is, they're customized between one counterparty and another. To terminate the contract early, one counterparty, either the buyer or the seller, must negotiate with existing other counterparty regarding the termination of the contract. And so futures contracts are best understood as simply a marketable forward contract. They're exchange traded. Forward contracts are over the counter, which means they're customized between two counterparties. Futures contracts are exchange traded, meaning there's a centralized clearinghouse. They're marked to market daily, so gains and losses are credited to your account each day, which minimizes your credit exposure to the clearinghouse. Forwards versus futures. The forward contracts, the gains and losses do not transpire until the position is offset. You have much more default risk, and it typically requires collateral to be posted by both counterparties and adjusted either monthly or quarterly. Forwards and futures are both obligations. They're not rights like options, which actually means they're much easier to value. Both typically have zero value initially, although you can have off-market forwards that are traded for a variety of different reasons. I want to introduce you to arbitrageurs that are active in the futures market. Remember, there are two guiding principles. Don't spend your own money and don't take any market risk. The goal is to seek positive cash flow today. Generally, these arbitrageurs are liquidity providers or market makers. They require access to a significant amount of financing, both borrowing and lending. Carry arbitrage is a particular arbitrage strategy that occurs when the underlying instrument is purchased and thus, air quote, carried through time. The air quotes are there because it's not real clear if you buy the S&P 500 index or SPY, the ETF that mimics the index, what you're really physically carrying, but that's not the point. The arbitrageurs will use borrowed funds and hedging the resulting price risk with a short futures contract. Reverse carry arbitrage is the opposite strategy, a particular arbitrage strategy that occurs when the underlying instrument is sold short, proceeds are invested, and price risk is hedged with a long futures contract. Carry arbitrage and reverse carry arbitrage are referred to generically as simply the carry arbitrage model. Notice that short selling is allowed with full use of the proceeds, which is a key assumption for the carry arbitrage model to function efficiently. The carry arbitrage model is a theoretical model that may or may not be supported by empirical data. We'll spend some time exploring this data. The historical origins is from the theory of storage. Caldor in 1939 coined the phrase convenience yield. If you're familiar with futures markets, you'll often hear this term used. The difference between the observed futures price and the current spot price is what is sought to be explained. Seasonal agricultural products, you can actually see this this variation in futures prices, and hence Caldor argued that there's a convenience yield of sorts. And we'll circle back to this issue in a little bit. Some of the implications, it's important that if the carry arbitrage model is valid, then futures prices evidence a fully arbitraged market, and all that drives futures prices are inputs into the carry arbitrage model. If you remember the S&P 500 futures prices we looked at before, there are only four inputs: the current spot price, the base interest rate or the risk-free rate, the dividend or dividend yield, and time to maturity. If the carry arbitrage market is valid, which it appears to be within the S&P 500 index, then that's all that should drive the observed pattern. If the carry arbitrage model is invalid, then the futures prices evidence an unarbitraged market, and other factors will drive the prices. For example, seasonal spot prices or seasonal expected spot prices, risk preferences, and many other potential factors. When the unarbitraged market is evidenced, then net hedging demand may be supported, or other theories. Futures price behavior is driven by hedging demand for futures contracts. Keynes and Hicks supported this idea. Keynes introduced the normal backwardation that occurs when futures prices are lower than the expected future spot prices. Remember, expectations are never observable, so testing these kind of theories is difficult because you really don't know, standing at a point in time, what expectations are. The futures expectations theory, the nth nearby futures price reflects at most the unobservable market expectation of the deliverable spot instrument price and perhaps an expected futures risk premium. There is some evidence in the natural gas futures complex of the existence of these risk premiums because of imbalances in hedging demand in the summer and winter months for gas. The time series of the spot index, the first nearby and third nearby, we'll analyze this with the S&P 500 index. We'll take a deep dive into some sub-period analysis to see what we can infer, and we're going to illustrate the marginal term premium, which we'll go into the technical details later, but it's just simply a mapping of the relationship between the third nearby and the second nearby and how it behaves over time. So figure 1 illustrates the S&P 500 index as well as the first nearby and the third nearby. And if you're looking at that and you say, look, I only see one line, well, that's the whole point, is that the nearby and third nearby at this scale level is indistinguishable from the spot. And so clearly with a more refined scale, we would see differences, and those differences would change over time. And if we just look at the basis follows a cyclical pattern related to maturity. The oscillations initially trend up. If you'll notice, like this is the third nearby basis, it trends up over time, and then later on it trends down over time. And remember, these futures contracts are on a quarterly cycle, so they're basically 4 trends per year. In the description, you'll notice that the nearby basis is closer to 0, and the third nearby actually gets quite a ways away from 0 at some point. At other times, it's very close to 0. Other times, often it's below the first nearby basis, and other times it's above the first nearby basis. If we overlay the LIBOR rate, which is the marginal dealer's cost of funds, made this a favorite of mine because it helped explain where the markets are, you'll see that the third nearby term premium, which is this graph here, is highly correlated to LIBOR. And if carry arbitrage model is true, we would expect that the financing cost of carrying the underlying would be directly related to the marginal term premium. Further, in light of the existence of a dividend yield, I would expect the marginal term premium to be below the base interest rate or the LIBOR rate. We'll pick up with this discussion in the next part.